Imagine you have an extra $300 at the end of the month, and you are standing at a financial crossroads. Down one path, you can use that cash to pay down your mortgage early. Down the other, you can invest it in the market. Over a 30-year horizon, deciding where that specific stack of recurring cash goes will dictate your final net worth by hundreds of thousands of dollars. If you ask for advice, you will hear two loud opposing camps. Financial conservatives demand you eliminate all debt immediately for safety. Conversely, investment optimizers insist you leverage low-interest loans to buy assets and maximize yield. Both of these rigid philosophies fail to solve the problem because they ignore half of the human experience. Finding the right answer requires a dual optimization approach. We have to balance the mathematical reality of compound interest against the requirements of your own psychological peace. This 30-year amortization chart shows early mortgage payments go almost entirely to interest. Because this timeline is front-loaded, an extra principal payment in year 2 instantly neutralizes decades of future interest. However, that exact same extra payment in year 25 has extremely low mathematical impact. Eliminating this interest acts as a guaranteed return. If your mortgage rate is 7%, paying it down early is mathematically identical to earning a guaranteed tax-free 7% yield on private investment. Broad market index funds operate on a completely different engine. By harnessing compounding returns across thousands of companies, you ride long-term economic growth. Staying in the market over decades historically smooths out short-term crashes to deliver high average returns. The sheer mathematical power of paying down your home rapidly diminishes with every passing year. Early mortgage payments are highly potent, but late payments are mathematically inefficient. In this 30-year simulation, the moderate line reveals wealth from paying a house early. The curving line shows that same cash compounding in an index fund. Dollars trapped in home equity cannot grow in the market. This widening gap creates a massive opportunity cost. Think of your financial risk like choosing a hiking trail. Paying off your mortgage early guarantees a perfectly safe, predictable hike to the top of a small hill. Investing is choosing a volatile, unpredictable mountain path. You will experience jagged drops and sudden storms along the way, but statistically, the trail leads to a significantly higher peak. If we base our decisions strictly on mathematical expectation and decades of historical market data, choosing the mountain almost always leaves you with vastly more wealth. If the math so clearly favors the stock market, why do millions of perfectly rational people still prioritize rushing to pay off their homes? The answer is rooted in a behavioral concept called loss aversion. Our brains are biologically wired to feel the psychological weight and stress of carrying debt far more intensely than we feel the joy of potential investment gains. Spreadsheets assume a perfect world. They miss unexpected job losses, prolonged economic recessions, or the primal need to know your family's shelter is unconditionally secure. Eliminating a mortgage pays out an emotional dividend. It provides the unquantifiable, daily psychological relief of knowing that no bank can ever foreclose on your property. We are humans, not algorithms. If the daily volatility of the stock market causes you chronic stress, chasing maximum yield at the expense of your health is an irrational way to live. To make the right choice, we need to build a decision engine that filters the raw math through your personal constraints. This matrix shows how to map interest rates against risk tolerance. If you have a high fixed interest rate, a low tolerance for emotional risk, and a strict need to lower your required monthly cash flow, aggressively paying down your mortgage is the optimal strategy. Conversely, if you hold a deeply subsidized low interest rate, possess strict investing discipline, and have a multi-decade time horizon, staying invested mathematically dominates. You can also choose a hybrid approach. Routing half your extra cash to the mortgage and half to an index fund is a highly effective way to hedge against both mathematical regret and emotional anxiety. The correct answer relies entirely on your specific interest rate threshold and your personal liquidity needs. Rigid internet ideologies have no actual utility in your financial planning. Ultimately, framing this as a battle between a mortgage statement and a brokerage account misses the actual objective. You're choosing the specific type of financial life and the exact level of daily stress you want to experience. True wealth is securing safety, optionality, and absolute control over your time. Maximizing the final digit on your net worth statement is a secondary goal. Whether you decide to secure the guaranteed piece of the hill or weather the volatility to claim the compounded wealth of the mountain, making a deliberate, informed choice based on your values is the actual victory. Mastering your money requires balancing cold logic with human nature. If you want to keep decoding life's biggest financial decisions through math and psychology, hit subscribe. We have a lot more to explore.